Unprecedented is a word that most of us have probably heard far more in the past few months than we would have ever wanted. Indeed, a search of the Australian Financial Review reveals that the word was used more than 330 times from mid-February until the end of March. And yet, which other word would you select to describe the changed circumstances that have confronted investment markets over the last few months? As investors, we are faced with global economies which are suddenly facing one of the biggest quarterly declines in growth on record, an increase in unemployment that barely seems believable, fiscal and monetary stimulus that previously would have been unthinkable, and then a bear market that has taken hold in an extraordinarily short time frame. Overlay this with an attack on personal safety and well-being from an invisible foe, and we begin to understand why unprecedented has been the word of choice. By way of complete contrast, we only have to step back 2 months to when global indices were printing all-time highs. We had been writing for some time that markets were extended and long overdue a pullback. Discussion with investors often turned to the absence of likely catalysts for a pullback, and it was difficult to argue the point. Our view has always been that catalysts are near impossible to pick. In these two respects, our views have been sadly proven correct. However, there is clearly no backslapping on our part, because in two other key respects, our expectations to date have proven to be very much wide of the mark. Firstly, we were of the view that whilst a correction was reasonably likely, it should be reasonably shallow, as we did not expect earnings to collapse as had happened in the global financial crisis. Global economies looked to be entering a firmer period following trade wars and the cessation of monetary tightening. Under normal circumstances, this would support corporate earnings. Secondly, given the extreme valuations accorded to leading industrial stocks, we were strongly of the view that the correction will be driven by the underperformance of this group of stocks, which have played such a big role in buoying markets to ever higher levels over many years. Considering the latter point first, it is clear that in the first 6 to 8 weeks since the bear market commenced, there has been little sign of a change in market leadership. In fact, the exact opposite has been the case, with long-running trends largely continuing to hold through to the end of the quarter, seeing further outperformance from this select group of industrial stocks. This is reflected in the chart. In some respects, this continued outperformance is unsurprising given the nature of the severe dislocation that has come upon the world. Whereas the outlook was for steadily improving economies and thus corporate earnings, which would have benefited an entirely different group of stocks, the reality is that we are now looking into extremely uncertain times, and this has merely reinforced the flight to quality at any price. Global uncertainties introduced by the fight against COVID-19 have seen interest rates test new lows, further boosting high price earnings multiple stocks. That is not to say, however, that such stocks have been immune from the pressures facing the market, merely that investors have taken a somewhat kinder view. Cochlear is a case in point. During February, Cochlear withdrew earnings guidance, noting that, and I quote, "The pandemic is expected to have a negative impact on cochlear implants for an uncertain period of time." End quote. This was on top of 2 patent infringement awards that went against the company. The combination of these events saw Cochlear undertake a capital raising to strengthen their balance sheet. Earnings have been revised sharply lower, up to 75% for the current year. And Cochlear being a stock that was trading on approximately 45 times forward earnings prior to these revisions. It might reasonably have been expected that Cochlear would struggle on this news, but the placement was upsized given demand, and the stock outperformed the market by approximately 5% in the week post-relisting through to the quarter end. The relatively neutral performance of stocks such as Sydney Airport and Transurban, both of which are facing enormous uncertainty, highlights again the obsession of the market with a favoured in-group of stocks. Many other stocks languish on low double-digit PE multiples and remain friendless. Warren Buffett's reminder that price is what you pay, value is what you get, hardly seems more apt than at this time. The lack of change in market leadership over this 6-week period has meant that most value fund managers have struggled in a sharply negative returning market. This is clearly disappointing given the struggles that value has had over recent years. We would make 3 points in this regard. Firstly, it is only a 6-week period and we need to see how this cycle plays through. Secondly, the concentration of approximately 17% of our index benchmark weight in only 2 stocks, CSL and CBA, both of which enjoy global standout valuations, means that the index, and thus performance outcomes, are very dependent on the trading in these 2 names, neither of which are held by the fund. Thirdly, whilst the value style in general outperforms in down markets, it is clearly not in every down market and is dependent on the drivers of the bull market and, of course, the underlying causes of the ultimate bear market.